Microsoft 13 billion to OpenAI. OpenAI 12.4 billion back to Microsoft. Google does it with Anthropic. Amazon does it with Anthropic. Nvidia does it with CoreWeave. The money never leaves. It just circles. And every circle depends on the same hardware. This is the AI bubble. And today we're going to show you how it works. Let's start with the most influential relationship in this entire ecosystem, Microsoft and OpenAI. When Microsoft announced it would invest $13 billion, it sounded like a historic bet, a decision that would define the future of artificial intelligence. But there was a detail buried in the fine print. Most of that money wasn't cash. It was cloud credit, digital vouchers that OpenAI could only spend on Azure, Microsoft's cloud. In practice, Microsoft financed OpenAI so that OpenAI could buy computing power from Microsoft. And every time OpenAI spent those credits, Microsoft recorded it as cloud revenue. It's like handing out casino chips, watching them get bet, and then proudly announcing, "Look how much money we made." The real scale becomes clear when you look at the numbers. In 2025, OpenAI was burning nearly $14 million a day, $13.8 million every single day. Annual losses were running between $9 and $11.5 billion. And if that pace continued, cumulative losses could exceed $115 billion by the end of the decade. Training models costs billions. Serving them to the public costs even more. And on Azure alone, OpenAI had already spent more than $12.4 billion, money that left Microsoft only to come right back to Microsoft. Now let's look at another key piece of the system, CoreWeave, a company that not long ago was mining cryptocurrency, and that suddenly became one of the largest providers of AI compute. In 2023, CoreWeave took out a loan for $2.3 billion. The amount was large, but that wasn't the shocking part. The collateral was. The debt was backed by 100 HGPUs, including units that hadn't even been manufactured yet. Yes, literally, chips that didn't physically exist. It's like walking into a bank and saying, "I want a mortgage using a house I'll build someday." And the bank replying, "Sounds good, approved." That happened more than once. To understand why banks accepted this, you have to look at Nvidia. Nvidia isn't just the chip supplier, it's a strategic partner. The two companies signed a deal worth over $6 billion, under which Nvidia agreed to buy any computing capacity CoreWeave couldn't sell. In plain English, go ahead and lend. If nobody buys what they build, I'll take it. With a promise like that, the loans looked a lot less risky, until the problem showed up. The H100s, the collateral behind all that debt, started losing value, and not a little. On the secondary market, prices dropped between 60 and 75%. When that happens, the financial system doesn't debate, it acts. When collateral is no longer worth enough, an automatic mechanism kicks in, the margin call. Imagine you finance a car and that car suddenly loses half its value. The bank calls you and says, "What you put up as collateral isn't enough anymore. We need more." That's exactly what happened to CoreWeave. And when a company can't meet those new requirements, even if it keeps making its payments, it enters what's called a technical default. A technical default isn't about missing payments, it's about breaking one of the contract's conditions. CoreWeave kept operating, but the numbers stopped lining up with the rules it had agreed to when it borrowed the money. That's why in 2024 and 2025, the company fell into technical default, not because it stopped paying, but because the real value of the chips no longer matched the math of the deal. While all this was happening, another quiet battle was being fought. The fight over who controls the compute that trains artificial intelligence. To understand that, we need to look at Anthropic, the company behind Claude. Before Amazon or Microsoft showed up with massive checkbooks, Anthropic had already chosen its first major partner, In February 2023, it announced a strategic alliance with Google Cloud. Google became its infrastructure partner to train and deploy models using GPUs and, most importantly, TPUs, Google's own chips. What matters most is what Google didn't ask for: exclusivity. Google didn't buy Anthropic. It didn't take control. It didn't take over the board. Instead, it invested between $300 and $400 million at first, taking roughly a 10% stake. Then, months later, it expanded the commitment by up to $2 billion more, with $500 million paid immediately and the rest pledged over time. All in, Google's real financial commitment was around $2.5 billion, cash, real capital. At the same time, Anthropic signed a commercial contract to use Google Cloud and train its models on cutting-edge TPUs. This wasn't a simple credit swap. It was money plus capacity. And as Anthropic trained larger and larger models, much of that capital flowed back to Google as cloud compute bills. In 2025, the relationship took a massive leap. Google reserved up to 1 million TPUs for Anthropic, more than a gigawatt of capacity, in a package valued at tens of billions of dollars in infrastructure, not equity, cloud capacity. And even then, Anthropic remained free to work with Amazon, free to use Nvidia chips. So much so that regulators concluded Google had no material influence over the company and formally approved the partnership. Months later, Amazon entered the picture. Amazon announced a multi-billion-dollar investment, and Anthropic named AWS as its primary cloud provider. That included training models using Trainium and Inferentia, Amazon's custom chips. By 2025, Anthropic was spending billions of dollars a year on AWS, almost all of its revenue. Amazon even built a dedicated supercluster designed exclusively to train Anthropic's models, a closed ecosystem carefully packaged. And then came the final move. Microsoft and Nvidia invested as well. Nvidia committed up to $10 billion, Microsoft up to $5 billion, and in return, Anthropic committed to spending tens of billions on Azure infrastructure and Nvidia GPU. Once again, the investment flowed back into the investors' infrastructure. Now comes the uncomfortable part: the math. To justify all the infrastructure being built today, the industry would need to generate around $600 billion a year in real revenue. Today, it generates about $100 billion. Even so, big tech is spending between $200 and $250 billion a year just on AI infrastructure. Without matching revenue, everything depends on debt, leverage, and expectations. Nvidia controls close to 90% of the GPU market for training. When a single supplier dominates almost everything, the risk stops being technological. It becomes systemic. Let's recap how this wheel works. Microsoft invests $13 billion in OpenAI. Most of it is credits. OpenAI spends those credits on Azure. Microsoft records it as cloud revenue. OpenAI needs more compute. Microsoft rents GPUs from CoreWeave. CoreWeave finances that expansion with debt backed by Nvidia chips. Nvidia backs the risk. The money moves in a circle. But that's just one circle. Because while all of this was happening, Google, Amazon, Microsoft, and Nvidia were all doing the exact same thing with Anthropic. Google invests $2.5 billion. Anthropic trains on Google Cloud. Anthropic commits tens of billions back to Google infrastructure. Amazon invests billions. Anthropic names AWS its primary provider. Anthropic spends nearly all its revenue on Amazon Compute. Microsoft invests up to $5 billion. Anthropic commits tens of billions to Azure. Nvidia invests up to $10 billion. Anthropic commits tens of billions to Nvidia GPUs. 4 separate investments, 4 separate commitments, all flowing back to the investors. And in every case, the demand concentrates on the same constraint, the same hardware, the same supplier. This isn't a circle, it's a system. Tech giants invest in AI companies. AI companies spend that money on the tech giants' infrastructure. The investment returns as revenue. The revenue justifies more investment. The wheel keeps spinning. It works as long as every piece stays in place, as long as nobody asks where the real money is, as long as growth never stops. Maybe artificial intelligence will change the world. It probably will. But behind every breakthrough, every demo, and every promise, there's a financial structure held together by debt, leverage, and expectations. The question isn't whether AI is the future. The real question is, who's going to pay for the future when the future finally arrives? That's the story. If this kind of investigation interests you, subscribe to Krento. Thanks for watching.